Back to the channel. As always, if you copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a stock called Pure Storage, ticker PSTG, trading at $70. So these guys work in the data storage and enterprise hardware sector. Their market cap is around 29 billion, and they are at the moment capitalizing on a massive new build refresh cycle that dwarfs the previous cloud boom. So hyperscalers like Meta, Google, and Microsoft are in the middle of a $300 billion infrastructure build-out to support AI. But they are hitting a physical wall. Their legacy data centers are out of power and space. And that's where these guys come in. They compete with the companies such as Hewlett-Packard and Dell, which provide the storage technology that we've seen in the past. That is primarily hard drive disks and SSD storage. Now, while SSD storage is better than hard drives, they deliver a technology called direct flash, which is the only solution that physically solves the physics problem. And that means that their solution consumes up to 80% less power than competitors. This has allowed them to pivot from a hardware box seller to a critical platform provider. The term for this is storage as a service. Now, they have a massive design win with Meta, which they currently ship more than 2 exabytes. And this has validated the viability of the technology, de-risking the decision-making for the remaining top 9 hyperscalers who are currently in active proof of concepts to introduce their technology into the data centers that they run. So when you look at the current landscape, many of those players built out their data centers back in 2018 to 2010. But as with anything in technology, and especially more so now with all the resources and microchips that require AI, they become obsolete fairly quickly and do need to be refreshed, to be upgraded in order to keep up with the energy requirements and processing power that the platforms are expected to deliver in the next few years. Looking at the thesis by the numbers, we have accelerating growth. So at the moment, we have many hardware peers in the macro that are struggling. But these guys signal that actually, for them, revenue is accelerating sequentially. So the company saw 12% growth in Q1 in revenue, 13% in Q2, 16% in Q3, and the guidance for Q4, which is reporting in late February 2026, is expected to be somewhere around 17. So definitely an upward trend. There are also qualitative aspects to this. So they are successfully transitioning to a high margin recurring revenue uh, model. Subscription services now make about 45% of their total revenue, and this evergreen model creates a sticky customer base, evidenced by Fortune 500 penetration breaking out to 63% in Q3. Also, uh, we see hyperscaler spend resilience. So, despite supply chain fears, the intent to spend from hyperscalers has accelerated. Major players like Meta and Amazon have explicitly raised their 2026 CapEx guidance, confirming that the capital is allocated and flowing. Pure's inventory build, which is about 76% quarter-on-quarter, positions them to supply this demand while competitors face shortages. It's a supply chain issue that has been going on for quite a while. So with that macro landscape, what are we likely to see over the next 1 to 3 months that is going to make this stock pop? Well, of course, we have the earnings announcement in late February. And the catalyst that I'm going to list might be announced by then, but we might see as well updates along the way, which are going to be equally critical. So first of all, management is mentioned in the previous calls that they are committed to providing additional color on the 2027 hyperscaler business model in the next Q4 call. So that means that potentially a hybrid revenue model guidance might be established. While margins may dilute slightly due to hardware mix, we expect volume guidance to be the primary driver, confirming the meta win was not a one-off. That will establish the legacy, so to speak, their name in the industry, and likely cause re-ratings from the analysts that will bolster the stock because they will be anticipating for the wins. There's also a Nutanix partnership general availability that could be happening between this month and the end of January. That represents the launch of the Nutanix on Pure solution, opening the virtualization market, taking away share from VMware. It's a different company. So that validates the platform thesis beyond hyperscalers, which is at the moment our customer base, showing that this company can actually win more business in the enterprise hybrid cloud. In other words, they are exploring a different total addressable market, which will open up the possibilities for revenue and EPS growth over the next few years. That certainly would dissipate a lot of the fears that we saw here in the recent drop after the latest earnings call, which uh, was driven not because the results presented were bad, but simply because management made comments that the capex, the money that they intend to spend to actually run the business, might be higher than they initially expected, and that led the market to punish the stock because of the valuation that is currently at. However, if we see that the company is moving to capture a new total addressable market, those fears could be dissipated due to the anticipation of much greater revenues and EPS down the line. And last is the new hyperscaler design win, of course. So we could see a new announcement of a second major hyperscaler customer. So for example, that could be Microsoft. That typically takes certain time. So the cycle to explore and execute and confirm this is about 18 months. That's typically how long it takes. But the reality is that many of the hyperscalers have been around for that long and have had the time to look at that. So that is one possible catalyst that we can factor in into the next 3 months. Now, in terms of risks, of course, there's always a question as to can hyperscalers delay the spending that they are planning due to supply chain bottlenecks, perhaps some increasing fears about the viability of economics in the AI space. Certainly something that we could see happening if the market starts selling off due to these fears. But in my opinion, many of the big ones have already confirmed their plans to commit to these expenditures, and they are all desperate and trying to keep up with each other. So, whilst that may be a risk um, for maybe one or two of them, I don't think it's likely that it's going to happen across the board to create uh, this kind of effect across the sector. So with that, likely the way that I'm going to be structuring this is by buying calls options in the month of March and selling them in February on a ratio spread. The timing for this is probably not imminent. We have seen a lot of volatility here over the last few weeks, and I think it's likely that the stock retests this standard moving average over the next few weeks, but that will provide us with some runway in order to target the end of March roundabout here. So likely might be revisiting this around the $65 strike. Hope you enjoyed the video. See you soon.